Welcome to Chapter 10. We are starting our very last unit. So we're talking about inventory here. We're going to be purchasing inventory to resell in a perpetual inventory system. So let's walk through these processes. Again, want to make sure that you have your notes printed, that you have them handy so that you can do these entries with us. You want to pause the video, really engage with the content. All right, so the cost of inventory is everything that we have to pay to get the asset ready for its intended use. And so since inventory, we sometimes have to pay shipping cost or sales tax and things like that with our inventory, those get included in the cost of the inventory. So shipping charges will get included if we, the buyer, have to pay for the shipping charges. So if the inventory or the purchases are shipped what's called FOB destination, then that means that the seller is paying for the shipping charges, and therefore the seller will include the shipping charges as an operating expense. This also means that the seller owns the goods while they are in transit. They own them until they reach their destination. So if we are the seller and we offer free shipping, which really just means we paid for the shipping charges, we would own the goods while they are on the UPS truck. We wouldn't actually, title would not technically transfer from us to the buyer until we receive notice from UPS or FedEx or whoever that they have been delivered, that they have reached their destination. Now, goods that are shipped FOB shipping point are paid for by the purchaser, and therefore the purchaser or the buyer owns those goods while they are in transit, and that gets included in the part of the cost of inventory. So if I'm the buyer and I paid the shipping charges, I'm going to debit the inventory account for those shipping charges. So if we have a purchase order, if we use a purchase order, we're going to send a copy of that to purchasing. We're going to send a copy of that to accounting so they'll know exactly what we purchased and how much we paid for them. And then a copy will be kept in the department that is making the purchase order request. So this is an example purchase order for Art's Wholesale Clothing Company, and we can see that Art is buying 100 ladies' jackets for $50 a piece from Abby Blake Company, and he's expecting for them to be terms 210 net 60. They're going to be shipped via freight truck. And so this again will be sent to the accounting department, to the purchasing department, and then a copy kept in the department that made the purchase request. Now, when the seller receives an order, they will prepare what's called a sales invoice. So here we see the invoice from Abby Company, and she is saying, hey, we are selling 100 jackets at $50 a piece to Arts Wholesale Clothing. And again, we notice these terms 210 net 60. All right, so once we receive the goods, remember we're the buyer here. Once we receive the goods, we're wanting to verify that they match what was on the purchase order. So if we ordered 100 jackets, we want to go through and count and make sure that we actually received 100 jackets and that they're all in good condition. Now, we'll have this approval form that'll go through and say, okay, here's the purchase order number. Here, yes, we've received these. They've been approved for payment because we're not going to pay it until we've received the goods and we make sure that they are in good condition. So let's go through some transactions here and we'll walk through these individually. And so again, you have your handout there, and after we do a couple, I want to ask you to start pausing the videos and working through these journal entries on your own. Don't forget your T accounts, and so we can really get practice on how to do these journal entries. So here we're told again, we purchased that merchandise on account. Remember, anytime we see on account, that means accounts receivable or accounts payable. Since we're the purchaser, since we're purchasing, it's accounts payable. Payables and purchasing go together. It was for $5,000 and $50 of freight from Abby Blake. Again, terms 210 net 60. So when we buy the inventory, we're going to debit the inventory account for the cost of the inventory. We're going to debit inventory for the cost of the freight charges, and then we're going to credit that accounts payable liability account to increase it for the total. So here again, we see our journal entry. Remember, debits are always listed first and they're left indented or left aligned, and the credits are always listed second and they're indented. And remember, the sum of our debits always has to equal our credits. So we have, oh, looks like we're missing some zeros here, but it should be 5,050. Now, you'll notice on the previous slide that we didn't just credit accounts payable, we actually credit accounts payable Abby, I forget what her name is. That's because really we're keeping what's called a sub-ledger or a subsidiary ledger. So really we have a teeny tiny T account for every single vendor that we own money to. And that way we don't just have it all in one giant accounts payable account. We're like, oh, well, this is how much we owe, but we don't really know who it's owed to. Now we know who it's owed to. So the giant accounts payable T account is what we call the controlling account, and it's equal to the sum of all of the subsidiary ledgers. Again, if you want to think of those subsidiary ledgers as individual T accounts. So this is a great visual. We have our accounts payable controlling account, and then we have our little t accounts for all of the vendors that we owe money to. And if we add all of those up, the sum would equal the balance in the accounts payable controlling account. So here we can see before we recorded the postings, we've got a posting to, we've got all of our subsidiary ledgers as well as our general ledger accounts. And here we've got some more journal entries. And now we can see where we've posted these to both the controlling account and the subledger. So notice in the PR column here, we've put the account number that we've posted to. So we've got the account number for merchandise inventory listed twice because we had two debits to inventory. But notice the PR column, the post reference column for the accounts payable. We've got the accounts payable T account, the account number of 211 posted right there. And then we've got a slash and a check. And the check says, yeah, you know what? We also put that in the subsidiary ledger. So it's really posted two places. It's posted in the subsidiary ledger and in the control account in the general ledger. Now, a debit memorandum may be issued if, let's say, there was a return and they were going to give us some money back. So the seller would issue what's called a debit memorandum. So here we see Art is issuing a debit memorandum to Thorpe Company. And again, goodness, we're missing a P here in company, aren't we? Thorpe is listening to Thorpe Company and says, hey, we're giving you a refund of $200 for 20 men's hats that were returned because they were defective. So here we can see we've debited accounts payable Thorpe and we've credited inventory because we were the buyer. And so now we owe Thorpe less money. Thorpe has issued us a debit memorandum, so we owe them less money. So we're going to debit accounts payable. Remember, accounts payable has a normal credit balance. So to reduce how much we owe Thorpe, we're going to debit accounts payable, and then we'll credit inventory because we don't have these hats anymore. But notice again the post-ref column, we have debited the PR column for the account number for the accounts payable controlling account, and then we have the check mark for the subsidiary ledger. And now we can see where we've posted these accounts. We've got our Abby Blake accounts here that we can see we've posted to our subsidiary ledgers. Notice down here at Thorpe Company, we've debited the Thorpe Company subsidiary ledger, and then if we were to add all of the subsidiary ledgers up, they would equal the balance in our accounts payable control account.